Welcome to the Galileo November update. I'm joined by the head of our wealth business, Yolanda Buerta. Thanks so much for joining us, Yolanda.
It's lovely being here. Thank you, Warren.
So we've had a mighty 2024 already, and it's not quite finished. We've got at time of recording just about 2 months to go. And it seems like a year of elections. I think by the end of this year, something like 6 or 7 billion people will have voted for a new leader in the world. We've had our elections, and now we've got our own wildebeest, or maybe the canoe, if you want. And that's working out okay, but we're still faced with a rather big election in the US, and at the time of recording, the voting or betting markets are very difficult to separate between Kamala Harris and Trump. So we're dealing with an enormous amount of uncertainty, and none of us, I think, have a clue what will happen in that election, and secondly, what that will mean for markets. So when we're in an environment like that, Yolanda, what on earth do we do?
Well, and I think we keep on beating the same drum always, and that is look at your strategy, right? But again, perhaps just to go back to what it means, and I guess it's to start always with what we can control and to focus on that. So it reminds me about a story. It's a shoe company that sent out 2 salesmen to a rural area in Bangladesh. And the one salesperson came back and said, I'm sorry, there's no opportunity here. They don't wear shoes. And the other salesman came back and he said, wow, what an opportunity. It's a great environment. They don't wear shoes. So it is really about what you focus on, right? So for us, I think it's always starting with the client's goals, their lifestyle, and what's important to them. But then to put a strategy together, we focus on quite a few different things, but one of the most important, probably asset allocation. And just to go back to why that is important and why we put so much emphasis on it, is perhaps just to go back to that study that we always quote. And this was a study done by 3 academics called Brinson, Hood, and Biebauer. Now, important that they were academics because it's not fund managers or financial advisors or anybody else that's trying to get assets onto their own books. So they looked at what drives returns over long periods of time. And what they found was 3 factors. So one was market timing, and we all like to talk about that. And the other one was trying to pick the correct share, the correct fund, or whatever that might be. And the other one was asset class allocation. So what they found was that asset allocation was about more than 90% driver of the long-term returns that people got. Market timing and trying to pick the correct share or fund were at much less of an impact. So, if it's that important and if you have that in the right balance in your portfolio for your situation, that is something that we can control. And that is something that we should focus on in times when things are really uncertain. Trying to listen to all the noise, and the noise in the market is always about market timing and trying to pick something. But just start your focus there, and then, we don't sit back. There's a lot of other things that we look at, but that's probably one of the most important things that you can control.
Yeah, and I think when you focus on those big swings, those big decisions, so that combination of cash, bonds, property, shares, I think we would also include in that our allocation to local and global investments. And for me, I think it's worth just revisiting. I feel like if we jumped back 2 years, and we were saying to our clients, I'm very sure they can still look at all the recordings to check us, but we would have been saying, be careful with your local and global allocations. Make sure that they're correct. Make sure that they fit your circumstances, your objectives, and don't be swayed by what's going on at the time. And jump back a year or two, and what was going on wasn't good. We were in the deepest, I'm sorry for the cliche, I guess, or the dad joke, but the deepest, darkest days of load shedding, we were really worried about, kind of commentators saying that there was this failed state on the cards. Really kind of frightening language. And if you jump forward to now, I just did a quick check before we started the recording. The JSE top 40, if you measure the top 40 index, is up more than 25% over a 12-month period. Now, that doesn't make up for all the years of poor growth that we've seen from the JSE, but saying to someone in this time last year, so end of October, beginning of November last year, before the elections in South Africa, when there was a very good chance that people were saying that we could have an ANC EFF coalition. The doomsday coalition was the phrase, saying to people then, make sure you've got your allocation to the JSE because it's going to deliver a return of more than 25%. I think quite a lot of people would have had me committed to some kind of mental asylum. And that's the point. So we're in an environment where the JSE is delivering a very good return. We would want it to give us a return over long periods of time, somewhere around kind of, let's say 12% a year, could be 10 to 15. But when you get a return of 25%, the temptation might now be to say, hang on, let's swing back all our overseas investments to South Africa because now the JSE is doing well. And that's not right. The trick here is get your structure correct at the start of your plan. Make sure your asset mix, including your geographical exposure, is correct. And then stay the course. We don't know what's going to happen in an election. We don't know how to predict the election. We also don't know how to predict what people will feel about the election, and most importantly, what markets will do as a result. And so, trying to kind of second guess all of these things and then make a decision in a time of massive uncertainty, to me, doesn't make sense. And usually, when we look at that and we look at the results of that kind of decision making over a 3 or 5 year period, when you look back, the decision making was poor. And it's hard to criticize someone in the moment for when they make a decision based on a prediction. But with the benefit of time, you realize you just don't know what's going to happen.
So again, to look at it rationally and then make your decisions from there, so that when we are in times like this, it's easier to stick to whatever you decided when things were a bit more calm. But you've mentioned Eskom, and I think, over the past few months, a lot of South Africans are starting to feel a little bit of a positivity, and it feels almost unusual. We've had our election, and the formation of the Government of National Unity was a big thing. And it seems like that has a big impact on the psychology of everyone around. Economists, a lot of them are predicting around 2% growth for next year and higher, which is lovely to hear. We haven't had that in the last 10 years. So, just perhaps your take on that, Warren.
Yeah, I do think we can take credit for one forecast. And what we said a year ago was that by the last quarter of 2024, the load shedding would be almost gone, or at worst at stage 1. So we were right in that, and the reason for that forecast was around the quantum of private power that was being added to the use or to use by South Africans. So not necessarily just to the grid, but also by private people putting solar panels on their roofs, bigger businesses taking themselves either off the grid or reducing the reliance on the grid. So we weren't even worried about Eskom doing a decent job. We were just worried about what private capacity could be added to the country's demand for power. What's happened to that is a positive surprise, which is Eskom's delivered much better performance than expected. So their energy availability factor, which is the kind of the pass mark for a utility, has been better than what was forecast and is continuing to improve all the time. And that's not to say that we won't see one or two stages of load shedding into the months ahead. That's very possible, but it's extremely unlikely that we sit with stage 4 or stage 6 again. and very likely that more and more private power comes onto the grid, and the reliability of Eskom continues. And it's important because I don't think in the last 6 months I've had a single question from one of our clients about Eskom. And maybe that's right, that you shouldn't notice a utility. When you switch on the lights, they should be on. When you switch off the lights, they should be off. And we shouldn't think about them again. But it was a dominant factor in a lot of our minds. Had a huge impact on psychology or sentiment, both for us as individuals, business people, and then the stock market as a whole. And so I want people just to think about that and just stop and take a pause. We don't have the doomsday coalition of the ANC and the EFF. We have a working utility that's doing not a great job, but a decent job. But then I want to throw in another swear word, Yolanda, which is SAA, something that attracted many thousands of columns, centimeters of columns in newspapers, online websites, radio shows, where we had this thing just sucking up money and being used as a source of corruption for a lot of connected people. It would surprise a lot of people to see, when you go to the airport, to see SAA planes flying, and at no time is there any money being paid to SAA from government coffers. It's working, and we're not talking about it. And again, it's probably right that we're not talking about it. Again, you should get on a plane and you should fly. Personally, I probably still have some psychological trauma from SAA, and so I'm not getting on that plane. But maybe I should. And again, it's to say that yes, we've got major issues around municipalities in South Africa, and that might continue for quite some time. Transnet is not where it should be, but SAA is working. Eskom's working better. It's very possible to believe that we'll see those kinds of experiences rolling out in the other big kind of infrastructure parts of South Africa at a time, and I'm saying it at a time when we're seeing news headlines about sewage being pumped into rivers because municipalities are doing a terrible job, and that there is a real concern about water. I know those things. It's not that we're oblivious to the problems. I think what's happening is that we're discounting the good news as South Africans. So it's always a yes, but okay, Eskom's working, but they're busy trying to fix Transnet, but the SAA is working, but so that's okay. I mean, retain your skepticism, but avoiding investing because of those kinds of issues, I think, is a mistake. We need to be correctly invested in South Africa as well. And I'm in no way telling people to bring back all their money from overseas to South Africa. I'm just saying that if you think it's a one-way bet, that you only invest overseas and you don't invest in South Africa at all, you could be missing out on good growth just from the government starting to do the simple things correct. If we get 2% economic growth and let's say another 2% just from a few reforms that actually work. Remember, Eskom's actually working. So a few reforms actually working is not an impossibility. We're in a position where the JSE is tremendously undervalued, and the opportunities are ripe for continued growth. So I do want to caution people, around being too optimistic when things go incredibly well, and again, too pessimistic when things aren't going well. And that's what I feel now is we're not used to things going okay in South Africa. The only thing we expect to go well is our rugby team, and so we go into a state of decline when the Springboks lose one match, and that's not accurate. And it's the same around the economy in South Africa. It's doing better than we all thought. The green shoots are very small. It is very early, but things are starting to improve, and we should be alive and awake to that, all of us as South Africans, to take advantage of those opportunities, to make sure that we realize that there are some people wearing shoes, but there are a heck of a lot that aren't, and the opportunity is there.
Yeah. I think just on power, if that was such a big detractor from economic growth, the converse must be true in some sense. So, and I think we're very bad at celebrating good times, and I'm not saying that it's the growth that we had over the last year is counting and making up for the last 10 years that we've had bad growth and nothing happening in these portfolios. But it is nice to see the market going up, and it's not very often when we have these discussions where we can say that. And I think we also need to celebrate the good times.
Yeah, I think that's exactly right. We will continue to tell our clients to kind of capture the return of the markets, and when the markets do well, we all enjoy that. It's certainly not Galileo taking credit for rising markets. What we try and take credit for is helping you to kind of stay focused on the long term, stay within your strategy, so that you do participate when the markets go well, and equally when the markets go down, and we feel pressure from our clients to do something, to take action, to sell something, and we don't do that. It's times like these where we need to remind you why we don't. We didn't sell out of the JSE in its entirety because we thought that was the end. We felt that markets do bounce, and that's what's happening now. How long it continues for, I don't know. At the time of recording it's going okay. The day after the recording, it might go down. Who knows? But what we do know is that that if we are strategic in our asset allocations, we try to remain rational in our decision making, and we do our best to convince ourselves and our clients to stick to a plan. It tends to work very well, and maybe that's the thing we should celebrate now, is that in general things are going okay. The fear monger in me always worries about that, about relaxing and becoming complacent, and that certainly we will never do. But you're right. Let's enjoy the growth that we've seen from the JSE. Long may it last. We don't know what will happen, and by the time the next recording comes, we will have seen an American election, and we will probably be saying the same thing: is don't panic if it's gone badly. We don't know what badly looks like. But just stay the course.
Yeah, absolutely, Warren. That's always our message, and thank you very much for your input on this.
And thank you to everybody for staying patient, and for staying invested, and listening to the message and embracing it where needed. We do think that South Africa is in a decent place with falling interest rates, falling inflation, hopefully a fairly strong rand, which will be good again for inflation, a little bit of economic growth, and we could be reviewing this newsletter recording in a year's time, saying how pessimistic we were and how things could have been a lot better. We just don't know. But let's maintain the faith in the strategy, and best of luck to the Springboks on the year into it. It's critical to the sentiment of our country.
Absolutely. Thank you.